Welcome to ECN Trade Daily Video. Before we begin, it should be noted that any advice is of a general nature only and that your personal circumstances have not been taken into consideration.
Hello everyone, my name is Rob Clayton and thank you for joining me. Viewing the Australian dollar index, which measures the greenback strength against a basket of 6 major currencies, posted a very strong close on Friday. From the lows of 99, we've got a hammer, and then we've got a dragonfly doji, and then 4 days of bullishness. In light of the pattern, this expects to continue this week on towards the region of 101 to around 102.20-30 area and reassess from there. All eyes will be on the US Federal Reserve this week when the US Federal Open Market Committee, or the FOMC, is widely expected to raise its benchmark overnight interest rate by 25 basis points to around 5.25 to about 5.5 range. It is the highest level since 2001. From there, many hope to see the Fed actually take a pause for the rest of the year. So all eyes will be on question and answer after 30 minutes from the announcement on Wednesday or Thursday at 4 a.m. Sydney time to see what Federal Reserve Chairman Powell says from the statement. Let's see, if it was a bit more dovish, then that would give a little bit more ease to the fact that the rates will be hold for the rest of this year. So after a week of taking heavy casualties, the Australian dollar attempted to regain its momentum but found heavy supply emerging and sending the market back down and now reaching its objective of 67.35. I do anticipate, given the fact that the market is still somewhat heavy and quite a large candle here to support the bear case, we are looking back towards a 60-day moving average, which is seen somewhere around 66.90. Any upside attempt for this week I feel maybe contained or capped by the level of 67.60-70. The euro, well, the market finally succumbed to the bearishness after backing away from that key level of 112.40.60. The bulls eventually threw the towel in and took the exit door. As the dollar strengthens, we can see now that the downside objective is around 110.75, with any upside attempt still likely to find a cap roughly around 111.60.70. That firm level around 112.40.60. Reassess from 110.75 as the market may find a bit of or potentially profit taking. Meanwhile, if the Fed is close to the end of its rate hike cycle or hiking cycle, the European Central Bank has much to do to catch up in its battle against high inflation. It is widely expected that the ECB this week will hike rates by 25 basis points to a range from 4% to about 4.25% this Thursday. Nevertheless, if the market finds a little bit of momentum, it still has the US dollar, which is weighted to the euro at 57.6. So it's unlikely the gains will sustain. And given the fact that the last 4 days have been negative since that topside rejection, the call is towards that level, as I mentioned, at 110.75 and reassess from there. Since the rejection from 137 figure 15 or figure 30 area, we can see that we've got an engulfing candle, an indecisive candle, and then a strong hammer to support the case for a further rise. But we needed the confirmation from 139.35, which we got. And from there, the call was at 142, which is where we are now. Assessing the market though, keep an eye on this level because if we do see a break of 142, that would give further scope or an extension towards 143 to 144. However, if we do see a bit of profit taking to the start of this week, we may see a small pullback, but given the fact on Friday from this strong candle, we could punch through this level and on towards the region, as I mentioned, of 143 to 4. The British pound continues to face downward pressure against the US dollar for the 6th consecutive day, following a significant drop in the UK Consumer Price Index figures last week. From the data, the headline showed that the consumer price inflation had fallen to a 16-month low year-on-year at 7.9%. That is from a drop of 8.7% in May. With the Bank of England's rate decision approaching fast on August the 3rd, the pound will likely to continue to experience further whipsaw price action, but holding in this current negative pattern here could see a further slide due to the fact that the UK-US rate differentials pointing towards a move to the broad index of 126.55 to 70. Well, the market also heard the cheers from the bears this week in the gold market, that is, after engulfing candle needed confirmation to the negative Japanese candlestick, which was confirmed on Friday after viewing a close beneath the level of 1,964. From the break, now reinstates a further bearish call, and that is towards 1,915 to 35 this week. Any upside attempts? Well, there may be, but I see resistance from 1,970 to 72. But overall, still anticipate the move towards the downside and continue on towards this region, as I mentioned, around 1,915 to 35. Wrapping up with oil, well, the market still holds to its bullish case, and that is towards the region, I feel, of $78 a barrel. In light of the current pattern and also the strong technicals that are in play here, any pullback likely to be shallow to around 76.10 to 75.20. Now, while that level at 75.20 is intact, then I feel the upside call remains to $78 and reassess from there. Well, that's a wrap to the start of this week. Thank you very much for joining me, and as always, look out for the interest rate report, and I hope you enjoy the rest of the day.